Whether you're preparing to retire or just seeking financial independence, the key is generating alternative income sources outside of your W 2 paycheck to cover your cost of living. And dividend growth investing is a great way to do so. So, if you're interested in learning more about this investing strategy and why it works, hit that subscribe button and join me today, right here in the Red Zone. In the hype of the AI moment the market is currently in, it's hard to imagine that there might be another approach to growing wealth than investing in the Magnificent Seven. So, if you'll take a step back with me, here are a few things you may not know about dividend growth stocks that are presented in a great summary by Nanalyze, and I'll put the link in the description below. First, dividends actually make up a little more than half of all S&P 500 returns from 1930 to 2019. Second, dividend growers returned over 12.5% annually between 1972 and 2019, while non payers only returned about 8.5%. Third, when dividends are reinvested or dripped over a long period, the total return blows away that of non reinvested dividends or returns of stocks that don't pay dividends. Fourth, once you need income in the form of dividends, you can ignore short term price fluctuations, which lets you sleep at night as you don't have to over rely on selling shares to survive. Depending on our time horizon, although we care about yield, we generally care more about how fast our dividends are growing. In fact, focusing too much on starting yield can cause us to wander into dividend traps that underperform long term or into positions that are more likely to cut their dividend, as there's a reason that the asset price has recently fallen underwater. Here are three hypothetical dividend based funds which we could invest $10,000 in and hold for 30 years, with Fund A paying 8% but not really expected to grow its dividend much. Fund B pays out 5% and is growing its dividend at about a 3% rate. And finally, we have Fund C, currently paying a 3% yield and growing its dividend at a respectable 7%. Notice in this hypothetical example how at year 18, Fund C surpasses its annual dividend of Fund B, which had over a 2% higher starting yield. Then Fund C surpasses Fund A at year 21, even though Fund A's starting yield was 5% higher. Finally, notice that once Fund C, the highest grower of the group, passes Fund A in terms of annual dividend payouts, it takes off exponentially in terms of that annual payout. To further demonstrate this strategy in action, I'm going to use one of the formerly popular ETFs, SCHD, which I hold in my own portfolio. Interestingly enough, the reason it has fallen out of popularity recently is due to its dismal price return this year. But the reason that we bought SCHD in the first place was to grow its payout, and it seems that hasn't stopped as its dividend is up 5.6% in the first 3 quarters of this year compared to the first 3 quarters last year. If you're reinvesting those dividends, you are getting more shares of SCHD than if its price was increasing, but I digress. Unfortunately, many people do not know why they originally bought an asset. We'll do two different scenarios here and two different time horizons. One assumes a 25-year-old who has $10,000 to start investing with a 30-year time horizon with a goal of retiring at 55. The other is a red zone investor turning 45 who has $500,000 to start a dividend growth position in SCHD and also wants to retire at 55. The 25-year-old can contribute up to $1,000 per month, while the 45-year-old has double that month, that amount per month to contribute. In both scenarios, we'll extrapolate SCHD's last 10 years into the future, assuming that past performance guarantees future returns, which it does not. And the second, where we assume SCHD only does about half as well going forward as it's done over the past 10 years, for both dividend growth and its price appreciation. In the first scenario, where SCHD's amazing dividend growth continues, we end up with a whopping $400,000 in annual dividends in 30 years. More realistically, though, as there will be periods of underperformance, we could end up with as little as 96K in annual dividends 30 years later. At age 45, again, where SCHD's amazing dividend growth continues over the next 10 years, we end up with nearly 100K annually. But more realistically, we probably will end up with something closer to 60K per year. Even with only 10 years here, we're generating a high yielder out of SCHD, even in the more realistic scenario, as our yield on cost starting at age 55 is 7.73%, and we didn't sacrifice future dividend growth to do it. So this strategy looks amazing, but if it's so good, why doesn't everybody use it? As we know, every strategy has a trade off. So here are the common criticisms of a dividend growth strategy. First is the dividend fallacy. If your stock is worth $10 and it pays a dollar dividend, your stock is now worth $9 and you have a dollar. Now, you didn't lose any money, but you didn't gain any dollars either, so it's not superior to a price appreciation strategy just because you get a dividend. However, there have been studies that indicate that dividend paying stocks don't actually go down by the full dividend amount on either the ex dividend date or the dividend payout date, but this is mostly true, and it's why it's labeled appropriately as a fallacy. Second, companies are paying you dividends rather than reinvesting in their company, which hurts the company's and your future growth. Now, that's true only if it comes with the assumption that the company is more efficient with that capital than you are. If you think that assumption is valid, I would say that you haven't worked at a corporate headquarters before. Companies waste money all of the time, and I would prefer they pass at least some profits along to me. So I generally reject this common criticism, as to determine whether it's true or not depends entirely on the specific circumstances. Third, total return, of which price appreciation is the primary contributor, is all that matters. Now, this is mathematically true, but again, it rests on an assumption that you can sell your assets at the price they are currently valued on paper. One obvious problem is that price fluctuates daily and can fluctuate to the downside quickly. The other problem is that people are not machines, and there are plenty of studies showing that, in general, anxiety increases and overall retirement satisfaction decreases the larger the percentage of assets that an individual needs to sell in order to generate that income when they stop working. Fourth, you'll never live off dividends, is based upon the current yields of assets and is true if older investors are just starting to pursue this strategy. However, this statement ignores yield on cost and the yield your portfolio is paying based upon your original investment. Despite that, I would say it is semi true, as few investors maintain the discipline required to execute this strategy over a long period of time. Now, there's nothing saying that you can't blend approaches of growth and dividend investing. In fact, my red zone portfolio does just that. I'm investing new dollars into income to better meet my goal of financial independence at an earlier age. I'm reinvesting all of my distributions in that portion as well as my dividend growth portion. I'm trimming my previously primarily VU and balancing toward dividend growth and income, also creating a bond ladder, and will, as I get closer to retire, bump up my cash allocation. Both of those are to mitigate against sequence of returns, fund emergencies, or fund short-term large purchases such as an automobile. For me, this gives me the best of both worlds. In the short term, retiring before I'm Social Security eligible, the income portion of my portfolio will cover my expenses. Since most of these are high yield or in the form of closed end funds, which generally do not grow their dividends, or in the form of covered call funds, which will require a reinvestment of some of the dividend to maintain it, or in the form of high yield ETFs, which again will likely not grow their dividends. This part of the portfolio will struggle to keep up with inflation, although it will likely still pay out close to 100%, even in some bad markets. Next, the dividend growth part of the portfolio will grow its payout over time to mitigate against long term inflation risk. Finally, the growth part of the portfolio should outperform over the long term in terms of price appreciation. And with most expenses covered by other parts of the portfolio, I can be selective about when I sell assets to rebalance to dividend growth or income, or even a bond ladder. So, are you a growth, dividend growth, income, or is a mix of the strategies more of your style of investing? Let the community know, along with your rationale on why you chose your investing style by leaving a comment below. Until then, I'll see you next time, right here in the red zone.